My name is Andrew Viero with VALoansOfCalifornia.com and Wealthwise Mortgage Planning in Folsom, California. My mission is educating those with military experience about the thousands of dollars that you can save when you use your VA home loan benefit to refinance or buy a home. Most people hear VA loan and think about buying a home. But did you know that you can use your VA home loan benefit to refinance too? Here's just one of the many reasons why a refinance might make sense for you. One of the things that you can do with your VA home loan benefit is a cash out refinance. And the benefits of this are you can just take money out of your home for any reason, like you can with other loan programs, with an FHA loan or a conventional loan. But the neat thing about the VA home loan benefit and a cash out refinance is you can actually get the appraised value of your home and get a new loan up to whatever the value is of your home. It's similar to if you buy a home with VA loans, you don't have to put any money down, meaning there's no equity. On a refinance, you can do the same sort of thing. Whatever the home appraises for, you can get a home loan up to that amount. So the benefit of doing a cash out refinance, one is potentially you could have a lower rate. But if you do a cash out refinance and you want to do debt consolidation, this is where the benefit really comes in. Because what you're going to be doing is you're going to be taking other debts, say you have credit card debt, or you have a car payment, or you have tax liens, or you have student loans. You can do a new loan. If you have enough equity in your home, you can do a new loan, take out extra money over what you already have your mortgage on. You take out a little bit more money and you pay off those bills. So that debt gets rolled into the new VA home loan, and then you have a new lower payment. Theoretically, this is why you would do something like this. And let's say you're looking at a credit card and the interest rates are in the 20% range, right? On your VA home loan benefit, your interest rate on that debt, now that you've moved it over from a credit card, is going to be much, much lower. Right now, where we sit here in the middle of June of 2020, the interest rates are in the low threes, depending on credit for somebody, right? So if you're comparing 20% on a credit card to the threes on a home loan, well, that's a pretty good deal. Or if it's a car loan or what have you. So you can consolidate all those payments, lower your monthly payment. You can do this and take the proceeds for anything that you want. The lender is going to ask you to write a letter as to what you're taking the proceeds for, because they don't want to see that you're just taking money out and spending it out in a casino someplace and wasting the money. But it's a great way to lower your monthly outflow, right? So if your current monthly payments, let's just say that your current monthly payments are $1,000 on your home loan and $300 on a car, and you have another $1,000 in credit card debt, minimum monthly payment. So that all adds up to, $2,000, $2,700. But if we refinance everything, maybe the payment comes down to $1,300 with everything new, right? So you can see you still have the debt. The debt is still is now on the home, but you have a lower monthly payment. Some things to know about doing this. If you're going to do a new VA loan, there is a waiting period. You have to wait 210 days from when you had to make your first monthly payment on the current loan you're in. So whatever the note said was your first monthly payment date, you have to wait 210 days from that to close the new loan, and you needed to have made at least 6 on-time payments on the current note. Okay, so for most people, they've had their loan for a long period of time, so that's really not a big deal. The 6 on-time payments, you have to have done that. Like I've said, 100% of the value of your home that you can do. Just know that if there's new rules under VA and with Ginnie Mae, on not getting into the weeds too much, but Ginnie Mae pools and costs of money, that if we go over 90% of the value of the home, the interest rates are slightly higher. Not a lot higher, but it's slightly higher because the cost of money is greater. The risk to the lender is a little bit greater. The other thing, if we're going to do a cash out refinance with VA, to protect veterans, the VA put in rules that says that we have to accomplish what's called a net tangible benefit for the veteran to be able to do this. And they gave us 8 different categories that we have to be improving your financial situation to be able to do the loan. And so long as we meet one of these 8 things, then we can do it. So one of them is we have to be eliminating mortgage insurance or private mortgage insurance, whether it's FHA or it's conventional loan. If we're doing that, we can do the loan. If we shorten the term, if we're lowering your interest rate, that works, right? If we're lowering your principal and interest payment, that counts towards that. If we're increasing what they call increasing residual income, so this goes back to the debt consolidation. If your total payments are $2,700 and we lower and now your monthly payments combined are $1,300, well, we've accomplished that. We've met that net tangible benefit. If we're paying off a construction loan, an interim loan, that counts. If we're doing the loan and maintaining less than 90% of the value, that's another way that we're doing it. So you don't have to take out 100% of the value, but if we keep it under 90% of the value of the home, that we're okay there. Or if we're taking you out of an adjustable rate mortgage and putting you into a fixed rate mortgage, that counts as one of those 8 things as well. Just remember that none of the VA interest rates are guaranteed. The lender is lending the money. When we get the loan put together, whatever the prevailing interest rate is, that's what you're going to get. The huge benefit about using your VA home loan benefit to do a cash out refinance over another type of loan. So to summarize, you get access to more equity on your VA home loan benefit. So they're capped at 80% of the value. We can go up to 100% of the value on the VA. And the interest rates are generally going to be more favorable under a VA home loan than they are under a conventional loan or under an FHA loan. And of course, with FHA, you have monthly mortgage insurance. So a lot of reasons to look at using your VA home loan benefit on a refinance. There's really not any reason why you can't use it. Give me a call. Let's talk through your options and see if this makes sense for you. So when we're talking about debt consolidation, I thought I'd give you an example of one of my past clients that we put this together for. This was a few years ago, and their initial concern was that the mortgage rates had actually increased since they got their mortgage, and most people don't want to increase their interest rate on their mortgage. But on a debt consolidation, sometimes it still might make sense. So in this case, their current home was worth about $450,000. We knew that going in. Their first mortgage was $374,000 at 3.5%, but then they had credit card debt. Their principal and interest on the first mortgage was $1,719. Principal and interest is what actually changes on a refinance. Taxes and insurance don't change just because we're doing a refinance. If your homeowner's insurance has changed on its own, you have increased premium, or let's say property tax assessment has changed, well, then we have to account for that in the refinance, but the refinance does not cause that. Their credit card debt, they had a lot. So all their debt added up to about $60,000. And then the payments that they had on those, these were the minimum monthly payments, that added up to $1,317. That wasn't what they were trying to pay. They were actually paying more than that. So when you add it all up, they had $434,000 in total debt on the household that we were dealing with. And their total payments with the minimum payments in there was $3,036. So when we put everything together and started looking at this, at the time on the new mortgage, interest rates had increased, and the new interest rate was a full percentage point above where they were, which made them nervous. But when we put everything together, we actually lowered the payment, their total outflow on including the minimum monthly payments, by $842 a month, which over 5 years, that was $50,000 that they were going to be able to keep in their pockets if they just restructured everything and did it this way. But the reality is nobody really wants to pay for credit card debt for 30 years. That's really not a good use of that money, and it makes it very, very expensive, even though the credit card rates were between 16 and 22% at the time. So in their case, they still had 27 years to pay off their first mortgage, and they really didn't want to start over for 30 years. So we calculated that if they added $117 a month to the new loan, they would still pay off all of the debt in 27 years, so in the same amount of time that they had. But the beauty was if they added $524 a month, inclusive of that 117, so a total of $524 a month to the new payment of $21.94, they would pay off and amortize out that $60,000 of credit card debt in 7 years, right? So instead of 30 years, they're paying it off in 7 years. And if they kept making that added payment, they'd pay the mortgage off in 20 years, everything done 20 years, 7 years sooner than what they were working on. And they still get to keep another 300 and some dollars in the bank, right? So your cash flow is better. In this case, if they took all of their savings and kept paying that over the life of the loan, they'd pay off the mortgage in 17 years. So really, how you do this is you can do it every month yourself, add principal to the payment that you send in. But a lot of people will tell me, hey, I don't think I'm disciplined enough to do that. So my recommendation is, if you use bill pay, and if you haven't, then set it up and build in the extra principal payment into your monthly payment that's going to get sent in on your mortgage. That way it's there every month. You don't have to think for yourself, do I really want to add this? If at some point something changes in your monthly cash flow in your household and you don't want to make the extra principal payment, well, you don't have to, but at least it's an incentive. You have to actually manually go in and make that change, so you can give yourself a path of least resistance to go in and make sure that that extra principal is made. So hopefully this makes sense. Let me know if there's something else you would like me to look at specific for you. 916-932-7160.
Thank you for watching. To learn more about this and other topics, please contact me, Andrew Vieira, with VALoansofCalifornia.com and Wealthwise Mortgage Planning. My contact information is listed below. It is my honor to help you use your VA home loan benefit to reach your real estate goals.